Hey guys, John Paulamy here, Actionable Intelligence. Today, Saturday, August 10th. This is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. I am not a registered financial advisor. I cannot give you individual investment advice. This is for informational purposes only. Please do your own due diligence on any companies or ideas mentioned here. It's your money, it's your responsibility. Okay, so volatility in the markets, right? Last week we talked about the yen carry trade as being one of the, along with some of the weakening economic numbers, as being a catalyst for a big sell-off. Then, this kind of, before I go further, one of the things that I've emphasized since I've been on YouTube or even in the newsletter is that in the Western world, at least, what's happened over several decades is the complete financialization of everything. The export of our industries, of our know-how, of our maker mentality of making things and doing things, big things. We've exported that. We've sent it all overseas because we financialized the economy, because companies were more concerned about quarterly earnings and compensation of executives and stock options and everything else. Okay. And this mentality has taken over, not just in finance, but in corporate America, to the detriment, I think, of the country. Now, that's a separate conversation, but as the economy has become more financialized, you have more and more of these little gimmicks and ways to get better yield. And again, it goes back to what Munger said, show me the incentive and I will tell you the outcome. What's the incentive? The incentive is to, if you're running money, is to outperform quarter to quarter, right? Outperform your peers, outperform your benchmark so that you can be getting your bonus. Okay. So you can get paid. Okay. There's no, how can we make money long term? Yeah, there are people out there that have that mentality, but there's not that many, because and part of the problem now is also investor expectations, not just retail investors, but endowments, pension funds. Everybody in my view, has unrealistic expectations on returns. And so if you don't deliver quarter to quarter beats, then you're going to be cannexed. It goes to the same thing in the newsletter business. The returns that we have are, over a long period of time, have substantially beaten the S&P, but quarter to quarter, month to month, year to year, they can fluctuate. Now, if you have a longer term mindset, it just depends what your mindset is and what your expectations are. And in my view, a lot of people have unrealistic expectations because of the financialization of the economy has led to outsized returns. This is also part and parcel of having, a zero interest rate policy for a decade plus, of basically free money so that every dumb idea could get financed. And this led to more and more speculation, vice investing or buying businesses. The best way to become wealthy, in my opinion, okay, is to start a business, okay, or buy a business that makes money and then reinvest that money back into the business and let that compound. Okay, so you can do that privately, create your own business and do that, or you can invest in publicly traded companies and businesses and do that. But most people don't look at it that way. These are trading sardines. These are, pieces of paper. People don't look at it as businesses. And so you get into things like this Japanese carry trade because it's a way in some people's mind to make free money. And the incentive is, hey, I found this way I can borrow in yen at zero or virtually zero, and I can buy NVIDIA. Even Japanese retail investors were doing that. Everybody was doing it. And so, when the problem is that because Japan's over indebted and they're printing all this yen, the yen was losing value substantially against other currencies. And they were beginning to have an inflation problem there. And so what they needed to do was raise rates. we're not talking about like what the US did when they went from 0 to 5%. We're talking about going from like 0 to 0.25%. And it caused this unwind. It caused this panic. Can you imagine? And so, so what happened? Because you financialized the economy, so you're so far out on a limb, what did they do? Within 1 week, the Japanese central bank panics and surrendered to the market. And so this is from an article at Business Insider. It says, Japan's central bank has capitulated to the markets. Just last week, the Bank of Japan hiked interest rates and struck a hawkish stance that signaled more increases ahead, following years of ultra-low and even negative rates. On Wednesday, Shinichi Uchida, a deputy governor at the Bank of Japan, said the central bank would not hike interest rates when the financial and capital markets are unstable. Well, they cause the instability. Goes on, there's a quote here from this official from the Japanese central bank. I believe that the bank needs to maintain monetary easing with the current policy interest rate for the time being, with developments in financial and capital markets at home and abroad being extremely volatile. So that's all it took, was this amount of volatility, this big sell-off. I mean, I think Japan market was down 25% over the last couple weeks. So, you saw what happened here in the US. You saw how volatility spiked. We're going to talk about that in a minute and what the possible repercussions are of that. But this isn't over in my mind. Okay. So they said, they surrendered to the market with the caveat for now, because at some point, because of their indebtedness, see, we're getting to the end game now of the financialization that's happened, and for the phony, fake way that these governments have run their fiscal policy for the last 40 years, 50 years, okay? And so they ran up all this debt, they can't pay it, and so, they've ran these ultra low interest rates. We have this inflation now that's becoming, a problem, has been a problem, is a problem. And so in order to reverse, now it's like you've smoked for 40 years, and, all of a sudden you're going to stop after you get told you have lung cancer. It's too late. And so we have so much, to use that avalanche mentality or analogy, there's so much snowpack, there's so much stuff built up now that when this thing goes, and all it takes is just a small bit of extra snow or whatever, and this thing starts and you get this huge avalanche. And that's what's happened. And so they pulled back from it, but it doesn't change the fact that they need to raise interest rates in Japan. The currency will become weaker and weaker against the dollar. And so it's not just the central banks. Remember, there are intermarket relationships here. So not only is the yen carry trade, a lot of people got hurt last week. A lot of stuff happened. Then we had the bounce. Again, expect more and more volatility, okay, which I have no idea how long or how far it could be or what the ultimate outcome could be. Is one of the scenarios possible that everything's fine now? Yeah, that's possible, I guess. But none of these imbalances, I mean, that's not even the right word probably, but huge imbalances that have been basically put in place because of zero interest rate policies, because of poor fiscal management, government policy, a whole bunch of things. Okay, it's all culminating now in these problems that are starting to manifest in the financial markets. And so, what happens if the U.S. starts cutting rates? Okay, so you have to look at all these intermarket relationships, which it's basically 100% certain that the U.S. is going to cut in September. We'll talk about that some more later on too. So what I need you to understand is that in the end, that these central bankers, this is why the bias should always be towards more easing. Not that I agree with it or think it's a good thing. They are always going to be biased towards more easing, more money printing, because they have no choice. The other choice is collapse in markets, a deflationary depression, high unemployment, civil unrest, social unrest, political unrest, financial, trauma. So expect a certain level of inflation to then be acceptable going forward. Okay. Because, I don't know how this all ends up, but to unwind this would create so much pain that in these democracies, it just won't be acceptable. And these people will not be in power any longer. I mean, you're talking about, 1929 type stuff. And I'm not saying it won't happen anyways. I don't know what's going to happen. But this should show you that just raising rates in Japan by 0.25% caused basically the biggest volatility spike in the third largest volatility spike in the last 20 years. This, you're on par with 2008 and the COVID crash. So, yeah, it's not over. Again, expect more volatility and be prepared for that. And it's going to be difficult, eventually, that doesn't mean there's not opportunities. Again, I've talked about that before. Where are the opportunities? Well, they're not necessarily in the United States tech sector. I've talked about these where I think, we're going from this tech, uh, type. The opportunities are in real tangible assets because the bias is going to be towards, well, number one, because of the underinvestment, and also because of the bias of the instability of currencies and the need for governments to cover up their fiscal irresponsibility with more and more money printing. Eventually that culminates in a problem too, but I guess that's how people look at it. That'll be a problem to cross when we get there. We just got to deal with this problem. So, they said here that, when they hiked rates at Bank of Japan, that they were going to have a hawkish stance that signaled more increases. Now they've pulled back from that because, they don't want to raise rates when financial and capital markets are unstable. Well, they're going to be unstable going forward every time they try to raise rates. You saw what happened. I don't know. I have no way of knowing how many people were able to unwind their debt or their carry trade situations or whatever they're in. I'm sure some people blew up, but if you're that person, do you think to yourself, okay, well, I got past that. I'm just going to go back to doing what I was doing. That's a big possibility. Or are people going to say, hey, wait a minute, I'm going to slowly get out of this while I have my, another bite at the apple? What do you think's more likely in the competitive environment of needing quarterly returns in people that run money? Are they more apt to say, I learned my lesson, I'm going to underperform now? Or I'm going to say, well, or are they going to rationalize it and say, well, they blew it up, I survived, let's go back to doing what we were doing, business as usual? Probably I would suggest the latter. That's human nature, even among people that are very intelligent and should know better. So you see, this is the VIX index. You see volatility spiking to 65. That's pretty high. I mean, this is a measure of volatility. It came down, crashed last week. It's coming back down because of some of the things like we just mentioned. But that doesn't mean that we're out of the woods yet, in my opinion. I wanted to show the last two volatility spikes. This is the chart only goes back to, I think, 2000. It goes back further. I think they reconstructed the volatility, but I don't think they really were trading this until like the early 2000s. I don't know the whole history of the volatility index, but the charts basically. Anyways, this is sufficient for our discussion. So these are the last two major volatility spikes. The last one was 85 during the pandemic crash, if you will, which was a man-made crash. And then if you go back to the tech wreck back in 2000, or the financial crisis, I'm sorry, in 2008, 2009, we had a spike to 89. So this spike here only took us to 65. Now we've had, between these two big events of the financial crisis and the pandemic crash, we've had spikes in here between, 48, 53, 50. And so this is, this is pretty interesting. So I expect this to, but you could be in a situation where, this is just like the tremors of a big eruption of a volcano. There's no way to know, and there's so many things now happening that there's so many plates in the air. We may not, a lot of times it would have been good just to buy when you have these huge volatility spikes like this. But now we're in a situation where things are a little bit different this time. Okay, so we'll have to see what happens, but this gives you some context, I think, of what has happened before. Now, these were periods of economic turmoil, quite frankly, recessions, severe recessions. This was the great financial crisis, and this was basically shut the world down. So these were very traumatic for asset prices, if you recall. That should be like telling you something. So this chart Jesse Felder put up, it's interesting. It says higher volatility tends to foreshadow slower growth. I'm showing you obviously here's real GDP in red, and here's the VIX advanced 3 months, 1 year change. And you see as volatility spikes, it's usually an indication of what? It's not like this is a boom times and everything's jolly and good. The volatility index would be down and stocks, would probably be doing well. But we're in a situation, I think, where growth is going to be, we're heading into a recession if we're not already in one. That's my opinion. I mean, I think it's becoming pretty obvious now. And that's what companies are sniffing out, right? They're saying, okay, well, we're seeing these things happen. That was exacerbated this recent move with the carry trade situation. But, as we head towards a recession, what happens? Revenue goes down, profits go down, earnings estimates go down, multiples go down, stocks sell off. Okay. And then you already have a market that's getting weaker. It's getting more and more concentrated in just a few names. And then you get, like we had last week with the situation with the SAM rule being triggered, and then the Japanese central bank triggering the yen carry trade blow up. Okay. And so these things all culminate. Okay. But you could feel, we've talked about that analogy before of the volcano and the earthquakes that happened before the major eruptions. And so this is, in the past, these spikes in volatility have kind of been precursors to lower economic growth. Note the chart as you go up to the top of the chart is negative economic growth. So I mean, that's kind of the explanation, right? So here is a pretty good article. I'll put a link to it from Louis Vincent Gave of GavCal. I put in here as the title of this slide, time to buy the dip, ? Depends on what you buy, ? So the article's pretty short. I'll put a link to it. I kind of liked it because it was talking about, okay, we had the spike in volatility. We had a sell-off. Is it time now to go back and buy the same stocks that were working before? Or is it time to shift? Are we in a situation where this is just a, pullback in a ongoing bull market for these stocks, and tech is just going to keep going, what he calls the efficiency stocks, your AI, technology? Or is it beginning of a rotation out of those names and into tangible, real things? And so a couple blurbs, I'll put a link to the article. It's a short article. I'll also put it in the weekly free email that goes out. Says here, back in 2000, when technology stocks hit the wall, one of GavCal's first clients told us, it's okay, bear markets serve an important purpose. They return capital to its rightful owners. That's also a Buffett Munger ism also. Behind this cynicism lies an inherent truth. Bear markets do tend to shake out weak hands, clean out retail investors, and punish those who operate with too much leverage. Another key function of bear markets is to transfer leadership from one country or sector or asset class to another. That's exactly what we're talking about here. That's what I've been talking about. Okay. This is exactly my thinking also. Another key function of bear markets is to transfer leadership from one country or sector or class to another. It's interesting. You can go back and look at previous bull markets. what the bull markets were in, you will note that after that sector, I don't want to use the word collapse, but goes into a bear market, it's not the sector that typically leads out of into the new bull market. And we've seen that. That's why these commodity resource emerging market outperformance relative to U.S. equity or developed markets, they go in these cycles where they're diametrically opposed, and they go on for years. And that's what we've kind of been preaching here and expecting. Another blurb from the article. Let's start with the old GAV-CAL notion that assets have value. Number one, because they are rare, like gold, diamonds, vintage Ferraris, and impressionist paintings, or two, because they are useful, i.e., because they generate cash flows. Bearing this distinction in mind, it becomes obvious that the bull market of recent years was primarily a bull market in efficient assets rather than a bull market in scarce assets. And few things are as efficient at generating cash flows as large cap technology stocks. Okay. And so we know the valuation metrics of these large cap technology stocks, and I've seen people go out and show how they're not really overvalued in their opinion relative to other periods and blah blah blah. I look at it this way: relative to useful cash generating real assets, okay, they are very expensive. As a matter of fact, relative to commodities, equities are the most expensive, and these technology stocks are pretty much the most expensive they've ever been relative to resources and things that you need. You can look around the room that you're in, and I've said this for a couple of years too. You can look around the room. Pretty much everything that is in the room with you right now has either been mined or grown. And we've had a decade of underinvestment in these things in order to have overinvestment in what GAV-CAL calls these efficiency assets, tech, high tech. And I'm not saying high tech's bad or it hasn't made our life better. I'm saying that valuation matters, okay? And that you can overpay for things, okay? You can overpay for a meal in a restaurant. It's not worth it. You can overpay for a vehicle. A lot of people did that during the pandemic, right? Cars were in short supply, and people were paying outrageous dealer markups because they wanted a new car. So this happens a lot, right? And so I think there is a chance to buy assets, but like I said, I'm kind of focusing on emerging markets. I'm focusing on that global south and east, that new fertile crescent, if you will. And I have a long-term mindset. I'm buying things that have what I believe undervalued cash flow generation ability, okay, that have been fully ignored and no one talks about or cares about. And I think those type of assets will come back into or become more fully valued. I think I talked about it before, but I mean, there are a lot of things happening amongst the 3.5 to 4 billion people that are outside the developed markets of the West, okay, in that area of the global South and East. And it's not just, go out and buy the MSCI emerging market ETF. It's like doing some investigating into specific countries, specific companies, and being able to buy things for 50 cents on the dollar that are generating cash, that have growth prospects, that are operating in areas that have positive demographics, in countries that are not necessarily as in the same debt and demographic time bombs that the West is in. But these are long-term concepts. These are not quarter-to-quarter decisions, and that's what the problem is. People don't have patience. They don't have the ability to have the over-horizon radar and think about things in logical steps over, like what's happening in the real world. So that's what I'm saying. If you're talking about U.S. markets, they're overvalued. We're going into a recession, and we're probably going to have a pretty significant bear market. This recent, uh, you know, tumultuous time of the markets in the last couple weeks is just the beginning. Okay. And so I think that, we could see, am I saying that's going to be like the GFC and the NASDAQ's going to be down 80%? I'm not saying that, but a typical bear market could be down 25, 30, 50%. So you need to be aware that that is a good possibility over the next 6 months to a year. And yet there are things you can buy in other countries that are, that are doing well. So this is from Game of Trades. This is a tweet X, tweet storm, whatever you want to call it. I put in here, will rate cuts disappoint investors? Recent history says yes. I've talked about this many times that a lot of people are getting jazzed up for rate cuts. We're going to get rate cuts and, the stock market's going to rally and blah, 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 blah. And what I'm trying to emphasize is that the last 3 rate cutting cycles have resulted in significant stock market declines. And so you need to be prepared for that. Now, in some cases, if you go through the whole, I'll put a link to it. I'm not going to show all the charts for this guy or these people, but they show what happened during the pandemic rate cuts, 2008 and 2000. In some cases, the market peaked before the rate cuts started, and in some cases, the market didn't peak till after rate cuts started. But in the end, the last 3 times that we've had a rate cutting cycle, and you can see the rate cuts here. Okay, this is 2000, and they've superimposed over the, this is like just the time frame when the market was declining, and they have more charts that show each time frame specifically. And so we're getting ready to go into a rate cutting cycle here. And so what's going to happen? Again, I pointed this out probably a month ago in the videos that the research has been done that if the central bank cuts rates and the economy is still, growing, then the market will go up. But most of the time, the central bank is cutting rates because you've either had a financial blow up like 2008 or 2000 or the pandemic, and the economy is getting weak, or the economy is getting weak, or a combination of both. So it's not that often that the economy is still growing nicely, unemployment is not rising significantly, and the central bank says, okay, well, we need to cut rates because real rates are a little bit too high, inflation's under control. Yeah, the market will go up in that environment. Most of the time, the central bank is cutting rates because of a financial blowup, or the economy is in recession or getting ready to, and they don't cut. In my view, the central bank should have been cutting rates already. They should, if you look at the difference between the Fed funds rate and the 2-year bond, it's pretty significant right now. They should kind of be tracking the 2-year bond. Okay. And so they're behind the curve. And by the time the news starts coming out, you got to remember the lag effect works both ways. It's taken a long time for these rate increases to have the slowing effect on the economy. Conversely, it will take some time for the rate cuts to have a impact on the economy. Now, note another thing. I've said for this before, you need to take note of this. When they begin cutting rates, it's not going to be, we're going to cut a quarter point. They always say that. We're going to cut a quarter point, see what happens. No, because the economic, the reason you're cutting is because you're in recession and the economic news is horrible. Again, it's kind of like a, step ladder going up and an elevator down when you're cutting rates. So, this is why I think you can expect more volatility. So this is showing you again the rate cutting cycles for the last. This is another one of the charts that they showed from their chart deck that I'll put a link to that was on X. These are the rate cuts in 2000, 2008, the pandemic. Okay, here, and then what's getting ready to happen here, and then this is the S&P in red, and you see what happened. Okay, you went from like 50. You can see the declines. These are pretty significant. Although it wasn't that bad in 2020, but still, I mean, relative to what we saw before. I mean, again, I'm anticipating anywhere in the S&P to be down over the next year, probably anywhere from 25 to 50%, depending on how bad the economic news is. So we'll see. And so I don't think you want to, and I think that tech and the leadership of the stocks that have done well will be the ones that get pasted the worst. They'll probably be down the most and even more than the overall market. Okay. I mean, you saw how much just in the recently what happened in the sell-off in the last week or so, just trillions of dollars of market cap evaporating. Okay. So I don't think we're done with this yet. So what am I doing? So, T-bills, and obviously I like resources. I like certain emerging markets. I've been vocal about that. I find value in those places. I like gold. That doesn't mean I like gold mining stocks. If you saw the earnings of the gold mining stocks this week, they weren't that great for most of the stocks. There were some companies that I've kind of talked about before, Nico Eagle, Alamos, they had pretty decent earnings. One of the companies I've been talking about, Anglo Gold, looks like their turnaround is happening. They had a bunch of flooding at some mines, and they've turned around. So we've got some companies, but you have to be very selective, right? And you have to do research. But people want the juniors. People think, well, I want to put $1,000 in a junior, and it's going to go to 10,000 or 50,000. I do think we're going to have a bull market in gold. We are in a bull market for gold. I do think we're going to have a gold mining or a bull market in gold mining shares, but it will start mostly with the seniors first, the larger caps, and then slowly move into the mid caps. But if you're a gold mining company and you can't make good money at $2,400 an ounce, are you going to be at 3,000? What are you going to do? So you really, again, have to do the work. What is this company doing? What is its cost? Where is the mining? What's it looking like? What kind of management? It's just like everything else. You have to do work. If you're just out there buying a basket of, juniors, that's a tough game. There will be a time when all of those go, because I do think that because of the money fest and the printing of money that's going to happen over the next several years, because of the wars that we're in, and because of the entitlements that we haven't paid for, and all the other problems that we've talked about, fiscal problems, I think gold's going to be in a bull market for a while and eventually have a spike at some point. Yeah, but I don't know when that is. And so I think, I see a lot of people on Twitter talking about platinum, for example. Let me just talk about that real quick. I like platinum. I think it's an excellent investment. I don't think internal combustion engines are going away. As a matter of fact, I think amount of cars in demand around the world has been, the supply has been restricted because of what happened during the pandemic, and coming out of that with the chips, a lot of the OEMs have put all these chips into the cars and other things. So as the supply chains gets ironed out, we're going to see, demand for cars increase. And so I don't think they're all going to be electric, even though electric vehicles are with us. But you've seen the stats. So I think the desire for more internal combustion type engines or even hybrids require platinum catalysts for the exhaust. I think is going to increase. And so, but does that mean I want to buy implats? Or, I mean, most of the companies that you can buy, there's like three. People are wanting to buy these things. Why not just buy the metal? That's what I've been doing. I don't have to then worry about what's going on in South Africa. I don't have to worry about what's going on at the individual mines, the costs. There might be a time, the time I think what to do is like what Paul Tudor Jones used to do. You understand the theme of platinum is going to at some point probably pay out, and platinum prices are going to go higher. You don't know when, and so what you do is you watch the charts of the companies and you wait till they're into a defined uptrend, then you get on. Okay, you build yourself a watch list and you visit it, or you put some ticklers on there and say, hey, it's going to break out of this channel or break out to the upside, or the 50-day crosses the 200-day, or whatever and that brings you back to look at it. Why just buy it and have dead capital in something, because you don't know when it's going to happen. In the meantime, just buy the metal if you're bullish on the metal. Then you don't have to worry about costs and all this stuff. You just buy the metal, and if you have a platinum bull market, you win because platinum goes up, the price of platinum, physical platinum you're holding, and then you can actually get on the ride when it's actually starting to move. There's no reason to just sit there for 2 or 3 years and wait for these stocks to move higher. If that's the case, that's kind of something that I've incorporated more into my thinking. Is, yeah, I want to buy these things early, but some of these things, you can sit like on uranium. I was way early on that, and I think that I could have honed in my timing a lot better. Okay. And I think that takes some nuance and some discernment, but I think you can get a better outcome that way. If you just want to buy it, you just don't have the ability. You say, hey, I think platinum's going higher. I don't know when, which we don't. I don't know how high. I don't either. And just say, I'm just going to go and make a basket of these companies, or buy one that I like the best. And, at some point I'm going to get paid out. That's another way to do it too. But understand there's an opportunity cost to doing that. So anyways, what I'm doing right now is I have a lot of money in cash, T-bills. I expect the Central Bank of the U.S. to be, it's pretty much 100% certainty they're going to cut rates next month. And this is what I'm showing you is a chart of TLT, which is the long bond ETF. Okay. And so I'm going to be moving, you see it spiked in the last couple of weeks just because of the turmoil we've had. A lot of people go into treasuries when you have market vulnerability and things like that. And then it pulled back. I think it's time to get into this. Now, look, I'm not, for the midwits out there that don't have any discernment, that doesn't mean I think that bonds should be bought and held to maturity. This is a trade. As the Federal Reserve lowers rates, okay, bond prices go up, okay, for the existing bonds that are out there. Why? Well, I'm going to show you an article from Investopedia. I'm not going to try to explain it. I'm going to show you the article, and then you can go read it yourself. So understand that's counterintuitive sometimes for some people, that when interest rates go down, bond prices go up. Okay, and it does actually make sense. So if you're cutting rates and issuing new bonds at 3% or 2.5% or 2%, okay, the bonds that are still, yielding 4%, okay, they become more valuable. That's why the price goes up, basically. Okay, conversely, it's the same thing. As rates go up, bond prices go down. If you own a 4% bond coupon and rates are going to 4.5%, 5%, 6%, people are going to want to buy those bonds, okay, and sell off the lower yielding. Okay, so it's all about yield. Remember, a lot of these bonds are bought by insurance companies, pension funds are trying to hit a certain return, guaranteed return. Again, this is a trade, and understand that the further you go out in duration, further you go out in time, the more the prices can fluctuate as rates go up and down. And so I think this is an excellent trade over the next 6 months. I just showed you that in the last 3 rate cutting cycles, the Fed usually is going to be an elevator ride down. Once they start cutting, I think they're going to be cutting pretty quick and heavily over the next 6 months to a year. Okay. And so it's not beyond, it's not beyond the possibility that you could very easily, okay, see a 20 to 30% capital gain in bonds, while the stock market, the S&P, is down 25 to 40 to 50%. Okay. And so this is a trade. So we were in a lot of T-bills. Understand that T-bills are short-term instruments. Okay. 1 month, 3 months, 6 months, okay, a year. Okay. And so as rates go down, the new bills are not going to be at 5%. So if they start cutting rates, the new bills are going to be slightly less, whatever the Fed funds rate is typically. Okay. So if they cut rates from 5 to 3%, you're not going to have 5% T-bills being issued. And so what you do is you start, if you know we're going to go into a rate cutting cycle, which we are now, then you start moving out on the duration curve so you can get a capital gain. Okay. And we'll still get interest payments for those bonds that we do own. Okay. But it's, I think TLT is yielding like 3.5% right now. So you'll get that, but you'll also have the potential for a capital gain. And so there's always somewhere to go to make money. And so that gives us time to get past this volatility, see what's happening, let this rate cutting cycle begin. Like I said, the probabilities are that the market's going to decline once this rate cutting cycle starts, okay, over the next 6 months to a year, unless, you know, if you think the economy is not going to go into recession, then the rate cutting cycle will yield probably positive stock market returns. I just don't think that's going to happen. You know, you have to ask yourself, why are they cutting rates? So the rest of the world's cutting rates, and I will talk about that. You know, I've talked about MoneyFest 2024. I've talked about how I track the interest rates. It's, you know, accelerating now. More and more central banks are cutting rates. The U.S. is one of the last. It was one of the last to raise rates. Now it's one of the last to begin the rate cutting cycle. And so a lot of things are going to change. These intermarket dynamics around currencies and interest rates, there's a lot of stuff going on. And so I don't think, yes, long term, I think the U.S. has a set in stone fiscal collapse, but that's not going to happen in the next 6 months to a year. And so I think TLT is the place you want to be. We were in T-bills quite a bit. I'm not 100% in T-bills. I'm always going to have a position. Like I said, I'm not going to not buy companies overseas that are selling for 50% on the dollar and have like 10% yields and their earnings are increasing. Those companies are out there. Of course, I've been buying some of that stuff. I'm not going to not own some gold companies. I'm not going to not own some oil companies. You know, we could have a Middle Eastern war and oil could go to $150, $200 a barrel. I'm not going to be 100% out of stocks. But would I be in there buying right now? Is it time to buy right now? I mean, there's this period of volatility. You don't know what's going to happen. I'm not saying that if you buy some of these things now, we've seen tremendous bargains, even in the portfolio. A lot of things have pulled back. Is it time to go in there and buy? A lot of the, you know, use uranium as an example. Okay. It's really pulled back significantly. There's, you know, sentiment is horrible. Is it still time to buy? Not if you're going to go into a bear market in stocks. You know, in a bear market in stocks, 95% of the stocks go down, even stocks that have good fundamentals, that have good stories, because people just sell. Sentiment becomes very negative. People become despondent. People have to sell. And a lot of the more speculative parts of the market, especially like resource stocks, they go down. This is mostly places where retail and people that don't have conviction are playing. So just understand it. I've been talking about this for a couple months now. And so this is what I'm telling you I'm doing. Now, I'm not 100% out. I'm never 100% in. Things are never as good as we think they are, and things are never as bad as we think they are. And so this is, you know, what are the probabilities? The probabilities, we're going into a rate cutting cycle. In the past, regardless of what the Fed says, they're going to probably cut in a typical rate cutting cycle 400 to 500 basis points. That's 4 to 5%. Now that's real interest rates when you know, so we'll see what happens. But this is what I'm going to be doing on Monday. I was waiting for this pullback after this spike. We know for a certainty now we're going to have a rate cut. They're not just going to do one and done. I don't care what they say. Once they start these rate cutting cycles, they're already, like I said, they're already behind the curve. I already think that we're probably already in a recession. Like, you don't know these things till after the fact. So I had the call wrong last year. So maybe I'm wrong this time. Maybe we don't have a recession. Maybe they're able to pull this off. We'll see. But this is what I think is going to happen and what I'm planning on doing. So this is the Investopedia article. Why do bond prices go up when interest rates go down? And I'll put a link to this. So if, a lot of people have asked me to talk about it. I mean, I'm not going to reinvent the wheel. They have a pretty decent article at Investopedia. And link in the show notes. It'll explain it to you. It's not really that hard to understand. Bonds have an inverse relationship to interest rates. When interest rates rise, bond prices usually fall and vice versa. To those unfamiliar with bond trading, the negative correlation between interest rates and bond prices may be counterintuitive, but it makes sense when you consider that a change in interest rates, up or down, makes bonds that were previously issued more or less lucrative to investors in comparison with the new bonds issued after the change in interest rates. And they go through some examples in the article. I encourage you, if you don't understand it, to go there and check it out. And then I believe you'll understand. And you'll also understand the fact that the further you go out in time on the bond maturity, why the returns up and down can be exacerbated. So I wanted to talk about MoneyFest 2024. This is a term coined by Greg Weldon, guy I like listening to. He has a service. It's pretty expensive. He's pretty good on some of this stuff. But he coined this earlier in the year, so I give full credit to him. Again, so far, my tracking, I just wanted to bring you guys up to date and why I'm positive on gold, why I'm positive overall in a lot of these other markets. And now that the U.S. is going to begin its rate cutting cycle, I think you're really going to see emerging markets outperform the U.S. So why? Okay, so far in 2024, central banks have initiated 100 rate cuts. That's total amount of rate cuts by central banks in 2024 around the world against only 19 rate hikes. So we are in a rate cutting cycle in the world. And when the US cuts next month, well, pretty much all the bazookas have now been pulled out of the lockers, locked and loaded and fired. Now, again, that doesn't mean the next day everything changes for the positive. All of this stuff works with a lag, as it did, as they raised rates. It took 2 years, or at least maybe 18 months to 2 years, because a 50% or 25% rate cut next month takes you down to 5% or 4.75%. It doesn't necessarily change everything immediately, but the direction is important. The direction is important, that we're in a rate cutting cycle and that the MoneyFest 2024. What I wanted to point out is gold is holding in fairly well at 2430. Okay. After all this turmoil, after all of this things that happened, I actually, in previous situations like this, thought gold would fall because it's such a liquid asset, but it's holding in fairly well, which is very interesting. So this is from the August gold update that Incrementum does every month. Ronnie Stoiffel's shop. They put this out. You can sign up for these emails. They send them out. You get the In Gold We Trust every year sent to you free. And you can also get these monthly updates. This is gold, the percentage increase in gold in various developed market currencies 2024 year to date. So you can see in Japan, gold is up 26%. In Norwegian krona, up 27%. In the US, up 18%. So you can see gold has performed amongst the emerging Australian dollar, the euro, Swiss franc pricing, all these different currencies, New Zealand dollar, Swedish krona. So across the developed world, gold is performing. Why? Because of, the MoneyFest 2024. Gold is a currency. It cannot be inflated. It's doing what it's supposed to do. And the same thing in the emerging markets. Here you have Nigerian currency. Gold is up 118%. It's because gold, because the Nigerian central bank is printing a lot of currency units relative to the gold price. You can't increase gold as fast as they're increasing the paper. And so this is the Egyptian pound. just go down the line, right? Russian ruble, South African currency. I mean, I don't know all of these. I can't, I think this is a Colombian peso, Philippine peso. I can't remember all. Mexican currency. So, and you have the world now all cutting rates. So people say, well, why is that inflationary? Because how do you get rates to come down? So when they cut rates next month, what will happen is the New York Fed basically has a trading desk and they will start buying bonds. Okay. They'll start buying bonds sufficient to lower the rates. Remember, we talked about how interest rates correlate with bond prices. So they'll be buying bonds in sufficient quantities to get the rate down. And they trade every day to keep that Fed funds rate in that area. They sell bonds and they buy bonds. They'll be buying a lot more bonds. Okay. That's why TLT's already started to move in anticipation of this. Okay. Or one of the reasons. Not only that, the economy's weakening and it's a safe haven, still a safe haven when you have market turmoil. But you see, gold is doing good. Gold prices. Now people say, well, the gold miners, John, the gold miners. Well, we just talked about that. You got to really do your work on these gold mining companies if you want to be investing in them. Now, I think that we're going to have a good bull market in gold mining companies. I don't know when that's going to be. Again, it will start with the senior miners, work its way through the mid, and eventually you'll have that junior gold mining bull market. You just got to keep your eye on it. We just have to watch and see what happens. But with basically all countries around the world now lowering rates for the, I mean, just about every country in the world's in a rate cutting cycle. I suspect that we're going to see gold prices continue to benefit from that. I mean, look at it. This is just, like I said, emerging markets, and this is developed markets. I mean, gold is in a bull market, guys. You know, that's why I encourage people to buy physical. Buy physical first. Buy your physical gold. Buy your physical platinum. Then you can play around with these mining companies. Okay? Mining's a hard business. If you like the particular metal, just buy the metal in most cases. That's what the average person should do. And if you want to get cute, then you really have to dig down and do the work to figure out like what companies are actually legitimate mining companies. Because mining, again, is a tough business that has been a net destroyer of capital over time. There are small windows when they do exceptionally well. Okay. And identifying that is very difficult. So this is another reason I'm bullish on gold. Gold continues to move from the west to the east, just like our manufacturing, just like the hegemon is going down, just like leadership in the world's moving from west to east. Everything's moving west to east, okay? And so this is the financial crisis, 27, 20 to 8. This is BRICS trio, Russia, India, and China. Obviously, a lot of people think that these reserves are much higher. These are just the reported reserves. We don't know what the actual numbers are because we're not going to be able to audit these central banks, but you get the point. You get the point. Okay, and this has been underway for a while. This has not been something that just happened in the last couple of years. This has been going on for a while because people see the handwriting on the wall. You know, outside observers, outside countries, they're looking at this. You know, we've talked about this before. They see the decline in the West. Now, if you're living in the West, you can disagree with me. Okay, you can disagree with me. The West is the best. The U.S. is the best. Blah 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 blah. That was true. They're in decline now. At least that's how the global South and East perceive it. And so that's why capital and gold and technology and manufacturing and power is moving from the west to the east. It's not something that happens in a week. It's not something that happens in a quarter. It's a multi-year, multi-decade process. And so if you want to know what to buy what the Chinese are buying. They're buying gold. So here's another thing I want to show. Now, I don't know, this is going to be like a general discussion because depending on how you model like GDP and things like that, you can do it with GDP or, you know, purchasing power parity, all these different things. I'm just using this to make the general point of what I want to make. So you see that according to percent of world GDP, This only goes back to 2018, but what I wanted to show you was that, this is a lot different now. But you see basically I threw this together quick because I want to make the point. There's an actual chart out there or graph that I haven't been able to find. But basically what I'm trying to show you is you see what the United States, you see Europe over here, you see Asia, China, Russia, South Korea. It's interesting they put Russia in Asia and not Europe because it's actually both, right? Then you have South America, other countries, Australia, blah, blah, blah. So anyways, the point I'm trying to make is this. When you look at this, you look at then the market cap of the world, right? This is in 2023. Probably been better to find a better GDP, but you get the point. So the US is like, 25% of world GDP, but the stock market is 42% of the global total. So you have this mismatch where like China's economy is actually much higher as a percentage of the world economy than 15%. Say it's 20% now. I think I saw a chart, but stock market's only 10%. And so what I'm trying to get the point across here is that as you have what I think is going to be a rebalancing as capital, as technology, as manufacturing, as perception goes from the West being the strongest, the best, to the global South and East, you're going to see that balance, that start to shift, capital's shifting over time. And so you're going to see, what I'm saying is that I think, the global South and East are going to become a larger part of, as the economies continue to grow and outgrow the West, which they will and are doing, that their representation, that their market caps are going to reflect that. And that's not current. Right now, the US and certain other countries are overrepresented or overvalued as a percentage of global equity relative to their GDP output. So again, this is a multi-year situation. It's not something that's going to resolve, but I wanted to kind of point that out. Hope you understand what I'm trying to say. So there was a better graph that somebody had, maybe Horizon Kinetics or somebody, I saw it, that showed the countries, Asia, the US and stuff, their market cap was more real time. I'll try to find it, but this is the point I'm trying to make, okay? So Americans are just stuffed to the gills with stocks. I like this chart. It's pretty cool. So you see, I remember the 1982 basically bear market bottom when Reagan got elected, when Volcker started cutting rates. It was a new dawn in America, as Reagan said. They cut regulation. You had a lot of things happening that really bolstered the economy. It wasn't just Volcker cutting rates. It wasn't just deregulation in the US. What else did you have going on? You had a Soviet Union that was economically in shambles. It was heading towards its final, decline and dissolution in 1991. And so what were they doing? Part of the things that really helped the US economy helped things were the USSR was chock full of commodities. They were dumping commodities on the world market. They were selling just to get any kind of hard currency they could get. Okay, they were selling everything. And so that helped push prices down. That was an economic boost. What was the other thing that was at the beginning happening? Well, the Chinese were just, changing things, using their great labor pool of cheap labor to start making things. This is when these things started. So that was another big long-term trend, okay? And so these things resulted in a huge bull market, and people, really loaded up on stocks up until you had basically, the tech wreck in 2000. And so, we had stock ownership at the bottom when people were turning off stocks. I mean, it was really ugly then, right? Only 9.4% of households and nonprofits own stock at basically the bottom in 1982. And at the top of right before the tech wreck, it was almost 40%. Now we're up to 41% of households because it's free money, right? The stock market always goes up. What I'm trying to point out to you is the fact that you see these signals where, everybody that probably the vast majority, which is retail investors, shoe clerks, bleacher bums, the average person thinks they know what they're doing. And a lot of this has happened because, again, 401ks and all this stuff, passive investing, okay? That works very well of pushing the market. You have this constant flow of cash coming into these ETFs, buying the largest, it's all based on market cap. So I think somebody said the other day, if you put $100 into one of these, into your 401k, one of these balance funds or S&P fund, 30% of it's going into the top 7 stocks because they have the largest market cap. Okay. The problem is when these things reverse, the same thing can happen. As money comes out, okay, those things get sold first. Okay. Percentage of those stocks get sold. That's why you have a tremendous volatility. And U.S. retail investors and households will always, they'll ride this thing all the way down. As you go into a recession, unemployment will go up. People will not be contributing to 401ks. I actually showed last week where the IRS has relaxed the regulations so people can take tax-free distributions for hardship discharges from their 401k. So that in itself won't cause it to go down, but you see, this is typically what happens. This is another indication of how overvalued and how we may be at a culmination point and reversal point for these markets. Wanted to show this. I'm a big advocate for eggs. It's a superfood. Just showing that depending on where you want to look, prices are not down. Okay, and I was actually just came upon this, thought it was an interesting thing to point out. But obviously, inflation's not licked. Let me put it this way. So I think what people are going to have to understand is that, we're going to have to accept. It doesn't matter if we're going to accept it or not. Prices are going to stay higher for longer. They don't have a choice at this point. Okay, so you're going to see more and more rationalizations, justifications, excuses, explanations of why we're not back down to 2% on inflation. Remember, you can go into a compound calculator and figure out why 2% over 30 years, how your purchasing power goes down. And so, again, I've talked about this before. Russell Napier talks about this. If you can go look at some of his videos, watch what he's saying about what he's talked about, yield curve control, how they're going to force people to buy government bonds, how they're going to keep the long bond interest rate eventually when they do yield curve control below the inflation rate and force people into these bonds. That's how they steal your money versus inflation. He explains all this, and that there are mechanisms because the government controls the legislation, right? And regulation. They can tell the banks, hey, we've decided that you must hold a certain amount of government securities in your portfolio. We can tell Fidelity and these other investment administrators, account administrators, 401k administrators, IRA administrators, people in these things, you must hold a certain amount of government bonds. And don't think it won't happen. It happens all over the world. I read an article one time that, somewhere around 50 different countries have done this at different points. So they have a whole bunch of cards to play yet. But it's all symptomatic of irresponsibility, graft, corruption, just evil. We don't have sound money. We spend, we think we can just do whatever we want. I mean, it's just a whole part and parcel. And again, the lower rungs of society that have no conception of anything about finance, inflation, they just go to the gas pump or they see prices for staples like this go up and they just complain, but they have no conception of why that is. And then that allows demagogues and retort people very good at rhetoric to get into power and keep the game going for the oligarchy and for the donor class that controls basically the U.S. And so people never get it. That's part of what I'm trying. I might be out on the front lawn screaming at the moon, but I think people are slowly starting to, first the realization comes something's wrong. I don't know what's wrong, but my life isn't, the same as it was. It's getting harder. It's getting more difficult. It's getting more expensive. And then it comes into some people then start trying to figure out why that is. And then the aha moment happens. Some people are never going to get it. Do not be one of those people. So tankers, I'm still positive on tankers. I mean, it's amazing to me that no one is talking about the fact that basically the Red Sea is basically people are avoiding it. Tanker rates are up because the trips are longer. So you need to carry more and more crude with the same amount of ships for longer distances. It takes longer. That's why rates are higher. So this is the CEO of Euronav. You can go listen to their conference call or check it out. We used to have it in the portfolio, but I sold it. I didn't like some of the goofy ESG statements they were making. But this is actually pretty insightful. So this Alexander Savary says more crude tankers will be needed to serve the world's energy needs for most of the rest of the decade. Well, for several decades, because oil demand is going up and the oil is being used in places where it's not produced. Hence, you need more transportation. So it says the chief executive of Belgian owner Euronav told analysts on a conference call that earnings are still above average and healthy compared to the last 10 years. So I'm bullish on tankers. I have been until I see a big, huge build out. Shipping is very interesting. A lot of people will say, well, shipping stocks, but you really got to look into, it's subcategorized into probably 9, 10, or 12 different sectors, right? Everywhere from LNG carriers, LPG carriers, auto carriers, product and chemical tankers, dry bulk, containers. I mean, all these different things. They all have their different dynamics. They all have their different supply and demand features. They all have the different aging cycles and build cycles going on. And so you really have to nuance this. And so right now, I think tankers and product tankers still have excellent prospects. Obviously, their stocks, the businesses, I like them. The earnings reports have been fairly decent. And so I still think that, the shipyards, you have a smaller amount of shipyards. The ships are getting older. The ship orders right now are mostly for container ships and other things. And so the ability to increase the fleets is kind of restricted for right now. And so that gives you a window for these higher for longer earnings to take place. And so what is that helpful to us? Well, the pay down of debt with those higher earnings and cash flows, the return of capital to shareholders via dividends and buybacks. That's what we're interested in, total shareholder return. So something I'm still positive on. Okay, so this is something happened with my computer, excuse me. So wanted to point this out. I found it amusing about the recent unrest in the UK. I've been watching Western Europe and the US. One of my biggest issue for anything as far as politics going forward is this mass immigration we've talked about before. And so what you don't realize if you don't follow it, and it's not something that you really want to think about, you've brought a lot of people in from places that the people don't share the same values or have the same way of thinking that the native populations have. Whether this is cultural, there's some religious influence, or a lot of religious influence. And it didn't really manifest because the numbers were small. But as the numbers have increased over time, we know that as certain populations get to a certain level in a society, they start exerting themselves politically. And so we've talked about it before. And so we had a recent situation in the UK where a person that was from one of these communities of immigrants, I think he was a first generation, the guy was actually born in the UK, went in and stabbed up like 3 little girls. And so that was finally enough. That wasn't like a one-off, like the media tries to, well, it's just a one-off. This is what we've been seeing. Okay, we've been seeing these grooming gangs where you've had Pakistanis and these other people in the UK communities basically grooming and abusing native English girls, teenagers, young girls by the hundreds and by the thousands. And the UK government, because of these Western governments' corruption and flat out evilness, has been covering all this stuff up. And it finally blew up the other day. And so, of course, you know, when Englishmen took to the streets, they're obviously, you know, fascists, they're right-wing zealots, they have to be put down. They would have counter protests. So instead of going in I mean, you see these horrific news items where somebody will rape, one of these people will rape, or an immigrant, one of these immigrants from this mass migration wave that we've had over the last 10 or 20 years into Europe, rapes a native teenage girl or a young girl badly, okay, and nothing happens to them. They get a small prison sentence or nothing. And then if you say anything, if you go out and protest, or if you say anything, you go to prison. I think there was a situation where a guy just put some flyers up about this stuff, and he got a 2-year prison sentence in the UK. You cannot do it. Yeah, there is a plan to displace the native populations with these people from the third world. If you don't see it, you're naive. I've talked about it before. I don't know if this video is going to get blamed or whatever. Now, okay, you have a situation where you had finally people started raising up. The Saxon is awakening, okay? And I'm not saying it's a good thing. This is what was predictable, what was going to eventually happen when incompatible communities are forced to live together and one starts preying on the other one, there's going to be pushback. Who didn't think so? The state, because it caused this problem, it doesn't know what to do. So what's it do? It cracks down on the native population that's finally had enough. And not only that, okay, now we're going to arrest people if they say anything. If you notice anything, if you notice it, that's going to be called, what do they call it here? Let's see here. What do they call it? Whipping up the hatred. Whipping up, yeah, I hate people that abuse children. Mr. Metropolitan Police Chief in London. Now, that doesn't mean I advocate violence, but we have to have a conversation about this. And if you're not going to allow a conversation, if you're not going to allow a different viewpoint, if you're not going to have discussion about it, you're going to have violence. If you take away people's ability to protest, if you take away people's ability to say anything, which you've done, if you persecute people who point out that the emperor has no clothes, then you're going to end up with violence. This is just the beginning. And so what do these people do in the UK? Here's what they said this week. They're going to go after people online, including people outside the UK. And this is dangerous because there are certain, the US, for example, there are certain states that might go along with this. I'm not saying it would be allowed by the authorities of the federal government. We had a revolution, we signed a peace treaty. We're not under UK laws here, but we're so woke and so goofy here that if you're in the wrong jurisdiction, you may be able to be extradited. Who knows what's going to happen? I'm just pointing this out, but this is what this knucklehead said. London's Metropolitan Police Chief warned that officials will not only be cracking down on British citizens for commentary on the riots in the UK, but on American citizens as well. Quote, "We will throw the full force of the law at people, and whether you're in this country committing crimes on the streets or committing crimes from further afield online, we will come after you," unquote, Metropolitan Police Commissioner Sir Mark Rowley told Sky News. A Sky News reporter asked Commissioner Rowley to further explain his warning, arguing that high-profile figures have been, quote, "whipping up the hatred," unquote, and that, quote, "the likes of Elon Musk," unquote, have been getting involved. She then asked what the police force's plan will be when it comes to dealing with people who are whipping up this kind of behavior from behind the keyboard, who may be in a different country. And so this is even contemplating this is dangerous. And yeah, Musk has been speaking up. I have to admit that several years ago, I was like very negative on Elon Musk, but I have to give him credit that what he's done recently with Twitter or X or whatever, you're still allowed to say most things on there. Not everything, but a lot of stuff. There's been a lot of stuff on there that you couldn't do a couple of years ago that you can do, say, and talk about now. We have to talk about this. Who authorized this mass immigration of these folks in? Who stands by and allows them to prey on young girls by the hundreds and thousands, and there's no repercussions? Of course, they've had enough. In Ireland, it's even worse. Do you know that in Northern Ireland, they had what's called the Troubles? You had the IRA fighting against loyalists, Ulster Defense Forces and stuff like that, people that were loyal to Great Britain, still Protestant people against Catholics, IRA Republicans. They actually marched together last week because they've had enough of this. A construction site was burned down. They put spray paint. You don't want to mess around with these Irish people. And now you have loyalists with Republicans marching together on this issue. You want to start that up again? Go back and look in the 70s, what was going on in early 80s when the IRA was fighting against Great Britain, okay, in the bombings, in the Troubles, they called it. You want to start this up now? They put up a spray paint, told construction workers, you're at risk, physically at risk if you come to this job site and work on this migrant center. They've had enough. And this was inevitable that this was going to happen. Inevitable. So what does Keir Starmer do? Gives a big speech. We're going to go after these right-wing extremists. We're not going to have a conversation about migration into the UK or into the West and why we're doing it, what's the benefit, and what are some of the downsides. We're not going to do that. You're going to take it and like it, and if you say anything, you're going to prison because you're a right-wing extremist full of hatred. And you expect people, you don't need all of the native population to agree. The IRA was able to cause a lot of problems in the 70s and 80s with a small group of dedicated cadre. You don't think that can't happen again? And now you have royalists marching with Republicans in Northern Ireland against migration. That's how bad it is. People have had enough. And it starts, I'm of Scots-Irish descent myself on my mother's side. I know how people are, okay? It's just like genetic. When you start it up with these people, you don't get to decide it's over. They decide when it's over. And people are, read about the hunger strikes among the IRA prisoners when they went to prison for bombings and extrajudicial or, killings, assassinations of British troops and officials. And I'm not advocating for any of this. I'm not saying this is a good thing. I'm saying it's inevitable because we have this, for some reason, I've talked about before, this mass migration into the West. For what reason? None of these people are able to contribute. They're not engineers, doctors. Yeah, there are some, okay, and they should be a small percentage of people. Then we just have mass migration of a bunch of 20s and 30s men into the country. Then they bring their family over. Everybody's seeking asylum. How many people are we supposed to take? There are legitimate questions around this mass migration into the West. How many are coming? A guy did the example the other day. I think it was a TED talk or a talk somewhere, and he showed migration into the West of asylum seekers before a certain date represented one gumball, and he put it down. And then into a jar. That's what would be the yearly 1 million people, I think it was the US. I can't remember. And then he showed all of these people that make like $2 a day or less around the world. And it was like jars and jars and jars of gumballs. You're supposed to just let all these people in. We can't do it. So if it's some misguided virtue signaling, we're going to save the world, we don't have the ability to do it. We have our own problems here. We have our own underclass here that we're not addressing the issues that they have. And you're going to bring in the rest of the world's poor? I am more cynical, and I think it's more diabolical. And I've said it before. It's to marginalize. It's the same thing. Look at what happened to the Plains Indians in the U.S. as the settlers moved out west. Just look at that. Okay. It's the same situation. Now, not to the same scale, but what is actually happening here? This is an invasion. It's not an armed invasion, but it's an invasion. So I don't know if what I just said is going to get me, extradited to the UK. Probably not. But this is dangerous territory. We cannot accept this as U.S. citizens. Enough is enough. The only thing that matters in this next election is immigration. Everything else comes from that at this point. That's the only issue that matters. And if you are not going to limit immigration in here, bringing in, I mean, we have criminal gangs operating from Venezuela, running around loose, killing people, shootouts, who allowed this chaos? And for what reason? You can't ask that question. That's not a legitimate question. What is the benefit to all of us that are already here to bring all these hard cases into the country by the millions, with all the other problems that come with it, the drugs, the violence, the crime? And yes, if I was a Guatemalan peasant, I would probably try to come to the US. I don't begrudge these people, but we have to fix our own country first. And no one's answering the questions. It's not so they can work, mop jobs or in McDonald's. We need the labor. Okay. We need to fix our problem here. We need to raise wages for people. But, there's no one representing you, the average person up in the government, right? The Democrats want more of these people in because, as Musk explained, the Electoral College representation in congressional districts is not based on actual American citizens. It's the actual population. So if you fill the joint up with a bunch of illegal aliens, that counts also towards the disposition of electoral votes. As people leave California, Illinois, New York because of these goofy policies, they fill it up with these other populations, and they don't lose congressional seats. They don't lose electoral college votes, okay, which is what would happen. So the game is being rigged cynically and diabolically against the native people. And I'm not just talking about white people. I'm talking about people that have been here for generations, African Americans, many of which have been here since the 1600s, Hispanic peoples that were originally here in Texas since the 16 and 1700s, Spanish land grant holders. Okay. I'm not just talking about, this isn't a racial issue. It's an economic and political issue. And you can't talk about it, or you're a right-wing extremist and you're going to be thrown in prison. That tells you all you need to know right there. Okay. So I just wanted to point this out. Susan Wojcicki, I can't pronounce it, the former CEO of YouTube, she passed away this week from a 2-year battle with lung cancer. She was only 56. I don't think she smoked. If you recall, during her tenure at YouTube, I have to be very careful with what I say here. She was, let's put it this way, very, very pro-vax. I'll leave it at that. And so I'll put a link in the show notes to another article by Vox Day talking about this. I don't want to talk about it on the YouTube. You can go read it. It talks about, when you get your ticket punched by the devil and you seek out material and worldly accolades, be careful. Because in my way of thinking, this is what happens. Okay. When the devil has no more use for you, in the end, you don't get what was promised. And so this person, there's going to be not a lot of, I saw on X, a lot of, let's say, negative comments about this person's death. A lot of people were damaged because of livelihoods were stolen. People were kicked off the thing. Maybe if this person I don't know, people get lung cancer, even though they're not non-smokers. A lot of people seem to be getting cancer since we've had the pandemic. Let's just put it that way. I'll leave it at that. But I'll put a link to the article if you want to go read it. I don't want to talk too much more about it. and get the video censored. Okay, guys, that's it for this week. Lots of stuff happening. You got to be paying attention. Again, I think T-bills and chill now. You got to move out on the yield curve. That's what I'm going to be doing next week, going into TLT and just kind of riding through the storm. I don't think you need to be in a hurry to be buying the dip. There's a lot of people that I've been hearing from. They're going to go out and buy the dip. I'm not sure we've seen the bottoms yet. You know, it's for each person to determine. But you know, again, I do think there's things to buy. You know, overseas and emerging markets, but we'll see what happens. Again, keep your head on a swivel. Watch your six. There's a lot of things going on. All right, we'll talk to you next week. Thank you.